Welcome to another one of our Money Talks video casts. Today is June 28th, 2010. This is end of the second quarter, and basically the markets are down now year to date. The market's down around 8% on the quarter. Unless we have something spectacular happen in the next couple of days, we're going to finish the quarter down, and again the year to date down halfway through 2010. What we're finding out is a lot of the problems that happened to get us into this deal back in 2007 is the debt issue. And what happened was the governments came in, global governments came in the end of 08, beginning of 09, and moved the problems that they felt were on the banks over to the public sector. And now what we've seen is the public sector, the sovereign countries. We see obviously Greece, we're hearing about Spain, Portugal, Ireland, Italy, and here in the United States, certainly probably 44 of the 50 states are having debt problems. And it's coming down to what's the right solution to solve the debt problem. So far, it's been for the governments to print more money. And now what's happening is certain governments, these sovereign debt issues, are having problems with people not wanting to lend them money for fear that they might declare bankruptcy, like Greece, for example. Even the state of California, it's a matter of do they make it? So without government, federal government assistance. So these problems are really here. They're roosting in there. The March rally that pretty much ended effectively the end of April of 2010 here was about a 13-month rally. It's broken, and it's a matter of, does 1040 on the S&P hold? Does 2139 on the NASDAQ hold? And they've been tested back in February and about 3 times here since April. And it's a matter of, if it holds, how much do we rally? Or if it doesn't hold, how far do we decline? So we're sitting in a heavy cash position. We still like gold, we still like silver, although those have shown a little bit of weakness here over the last couple of days. But it does seem to me that global currencies are having issues. It's a race to devalue your currency. Everyone thinks we can export more if we devalue our currency. But kind of like this China thing. China said, okay, they'll let their money float against the US dollar, but that just makes our goods that we import more expensive, and we import a lot of stuff from China. So in the short term, I don't know how that helps us. In the long term, they're thinking, well, we can export more at a cheaper price and be more competitive with China. We got a long ways to go to be more competitive with China with our labor laws. So we're in a situation where we're heavy in cash because we're in a trading range between 1040 and 1125 on the S&P. That's only about 6-7%, and it's very risky to trade in that environment. We thought things looked better when the downtrend was broken. We started going into this uptrend. We thought the 200-day moving average was broken above. Not a situation to really be a long-term investor in. It's a trader's market, and really you've got to be a risky trader to trade in this market. If 1040 and 2139 on the S&P and NASDAQ break, I would expect a drop down to 875, somewhere in the range where we were last June and July, 875 to 950, which is 10% lower than where we are today, a little bit more than 10%. And that could happen. That could be a very precipitous drop. So again, the best thing to do is to play defense in this environment. There's a time to be more aggressive, and there's a time to be less aggressive. The winner of the Indy 500 won by being in pit row with the wheels off, getting gas at least a few times throughout that race, not even moving. So these are one of those times. We have a few positions on, but this is a time to be very, very cautious. Another red flag warning is the treasuries. If you look at where the 10-year treasury is, it's just over 3% today, and the 30-year treasury is just over 4%. These are historically low levels. If you've got a mortgage and you haven't refinanced yet, call your broker, call me up. I'll give you a recommendation for a mortgage refinance broker. If you can get the loan, if your credit's good, now's a good time. We're at record low mortgage rates because of these super low interest rates. But the super low interest rates are signaling that the economy is going into deflation, not inflation. Now again, the opposite of that is, why is gold doing so well? Gold is a signal of inflation. Well, gold might be doing good because there's a global devaluation of currency. So it's important to use stops. If you're long, basically you own a bunch of mutual funds, you're not sure what you have, you say you're in it for the long term. Folks, the long term is the last 11 years. The markets are still down. This is not a time to play games. Get your portfolio reviewed today. Call my office, 800 449-9501. Again, you can look up here, right above my hand here. It says free educational newsletter. We do write a lot more often than we do these video casts. We also do our podcasts, audio podcasts. If you don't like to read, you can listen to it. Sign up. It's free. There's no obligation. And again, we'll keep you posted in terms of what our thoughts are and what we're doing. If we think the coast gets better, the coast gets clear, we'll go long. But right now, we're in this trading range waiting to see what the next leg is of the market. Is it going to go down? Is it going to build a base in here and start to go up? But right now, the information looks negative, and we're very, very cautious. So we're raising the caution flag. Again, look us up on our website, www.yourmoneytalks.com. Send us an email, or again, call toll-free 800-449-9501 for your free, no-obligation portfolio review today.